To talk about that, let's welcome on board Mayur Patel, the fund manager of listed equity at 361 Assets. Mayur, hi, good afternoon. Thanks so much for joining us on the show. And give us a sense of what you are making of the union budget. Really interested to get your take over here. Consumption has been a very heavy focus on the budget this time. It's been a largely consumption driven budget. Give us a sense of which sectors in particular do you see benefiting from this and to what extent?
Very good afternoon. So it was evident in the budget that government's focus has shifted towards reviving consumption. So the 1 lakh crore tax stimulus is clearly going to boost urban discretionary spending. And if you see, we have around 7.5 crore income tax filers, and based on some workings and certain assumptions, it seems that 1 to 2 crore taxpayers would get around 4 to 6% boost on the wallet, which is actually good to drive some uptick in discretionary spending across segments like consumer durables, auto, QSR, travel, etc. So it's going to definitely stimulate sentiments. And as we've always seen that the first leg of a cycle is always triggered by uptick in sentiments. And with a lag, the tangible factors contribute. Also, going forward, next year we have a pay commission, which is going to come up with hikes, and that's also going to add on to the consumer demand. So consumer discretionary as a sector has been, going through a really weak patch over the last few years, and it is set for a recovery this year.
This is Shrishti also joining in. But given the announcements in the union budget, yes, indeed, the focus was on fiscal policy. But today, the monetary policy focus has been taken away. The RBI decision is through. Help us understand that what were your key takeaways in the sense that why the markets don't look that excited, Mayur? Because all in all, most of the announcements were made as per the market expectation. But today, why the market is reacting this way, if you can give us some sense there. But in the long run, how can we see the benefits coming in from this policy decision?
I think the RBI announcements in this policy were clearly in line with expectations. 25 bips rate cut and maintaining the neutral stance, not jumping the gun in terms of going really dovish when you have such a huge uncertainty around global factors. So I think there is no reason for market to read anything really negative out of this policy announcements. But I think the market from September onwards, if you see, the market has been in a correction mode, driven by, I would say, more of a global factors. And if you see last 1 month, we have seen around $8 to $9 billion of FII outflows, driven by broad-based selling across emerging markets. So the key factors are hardening of US Treasury yields and also stronger dollar. So always whenever we see a sharp jump in dollar, FIs tend to pull out money from emerging markets. So I would say it's more of a global factors coupled with a transitory slowdown in economic growth, which we saw, and also a starting point of expensive valuations. So all these taken together is driving this correction, and I don't think so today's announcement has anything to do with the adding on to any more weakness in the market.
Right, Mayur. But other than that, in the medium to long term, how do you see the financials getting impacted, and what's been your take in your overall financial space in terms of the banking sector, housing finance sector, any segment where you are building a constructive view?
So if you look at banks, would continue to have a slightly I would say soft earnings growth period, getting into rate cuts going ahead, and some bit of margin pressure coming in, and they've seen the best of the credit cost in the base. So that way, there are no really large exciting catalyst for banks in the short term. But some of the NBFCs with a very strong franchise have taken some temporary hit on the credit cost side. But as we see a couple of rounds of rate cuts going ahead, And like I was talking about consumer discretionary picking up this year with declining rates, I think some of the stronger franchises in the NBFC space could benefit more. But all said and done, the private banks are in a value zone given their healthy ROEs.
Also help me understand this, that when we've seen the FMCG numbers come out recently, the commentary has still continued to be that rural is improving but urban demand continues to remain sluggish. That is what the RBI governor has also flagged off in his speech earlier today. Given both of these factors that are largely playing out, consumption is taking a back foot right now, although the budget may give it a fillip. Help us make sense of what the GDP forecast is like when that has been given by the RBI governor today. Do you believe it is slightly optimistic given the way the economy is panning out right now?
You rightly mentioned urban consumption has been very weak, and we have seen an uptick on the rural side, and that is one of the reasons why in the finance minister took a call to introduce these tax relief, which primarily is going to boost, urban consumption. So that these things will play out with a lag, but I think the sentiments, will play in the first leg, and we should see some uptick in the urban consumption side. But coming to the, GDP growth numbers, I think the India growth story is intact. The consumption part was very weak last few years. Central government capex was driving the growth. Now that piece is taking a back seat. But at the same time, if you look at the, some of the other sectors, other segments of capex, which are not dependent on central government budget, like power T&D and renewables, these kind of sectors would continue to fire well. And the manufacturing is a story. The Make in India would further pick up pace in terms of across sectors like solar, battery manufacturing, electronics manufacturing, semiconductor is coming up. So these are new segments of manufacturing. It will also lead to pick up in capex. So while your old school large segments
Mayur, would like to really thank you, but we just have to cut into the RBI governor press conference where our